If I could show you exactly how a $2 million retirement portfolio runs out of money by age 78, would you want to see the math? Because that's not a theory. It happens every single cycle. And it doesn't happen to reckless people. It happens to disciplined, intelligent, high-income professionals who did everything right. You see, the problem isn't saving, and the problem isn't investing. The problem is building a portfolio designed to grow, but not to pay you. And in this video, I'm gonna show you exactly how the collapse happens, the hidden structural flaw inside most retirement strategies, and how to engineer an income system that isn't dependent on perfect timing. But this is what most people miss, and I'll prove it with real numbers in just a few minutes. I'm Adam Williams, founder of LFS Capital. Last year alone, I completed over $200 million in multifamily transactions, and I added more than 1,300 units to our portfolio. I've been investing in multifamily for over 2 decades, and this is all I do. What I'm about to walk you through is not theory, it's actual operating experience. And halfway through this video, I'm gonna show you the exact shift that separates investors who feel trapped from those who feel free. Let's get started. What happens the year you need income and the market disagrees? What happens if 5 years before retirement, your portfolio drops 30%? Do you delay retirement, reduce your lifestyle, or sell into a downturn? See, most investors don't know because most investors were never taught to design income. They were taught earn more, save more, max out the 401k, and wait. But no one explains what happens when withdrawals begin. And in about 2 minutes, I'm gonna show you why that detail changes everything. Let's dive deeper. 2 investors, same age, 60 years old, starting with the same portfolio of $2 million. Same annual withdrawal goal, $120,000 per year, and the same long-term average return of 7%. On paper, they're identical. Let's talk about investor A. He has a strong first 2 years. Year 1, his portfolio grows by 10% to $2.2 million. He withdraws his $120,000 and he has an ending balance of $2,080,000. By year 2, his portfolio grows by another 8% to $2.246 million. He withdraws $120,000. He has an ending balance of $2,126,400. Momentum is working in his favor, and over 20 years, the portfolio sits at nearly $2 million. Retirement feels stable. Now watch what changes. Investor B, he has a downturn in the first 2 years. Year 1, his portfolio drops by 20% to $1.6 million. He withdraws $120,000. He has an ending balance of $1.48 million. By year 2, his portfolio drops another 10% to $1,332,000. He withdraws $120,000 and he has an ending balance of $1,212,000. Same investor, same discipline, same average return assumption, but now he's starting year 3 down nearly $800,000 from his original value. Even if markets recover and average 7% going forward, continuing to withdraw $120,000 annually depletes his portfolio by around age 78. If that makes you even slightly uncomfortable, stay with me because the solution is not higher returns, it's structural. And this is fixable with what I'm about to teach you. See, right now, most people think, okay, so I just need to lower my withdrawal rate. No, that's not the fix. The real fix is how much you depend on volatile assets for income in the first place. And this is where most investors either level up or stay stuck. Let me show you the third path. Investor C retires with the same $2 million, but instead of relying entirely on market withdrawals, they allocate $1 million into diversified multifamily investments, producing a conservative 7% cash yield. That generates $70,000 per year in passive income. The remaining $1 million stays in growth investments. Now, instead of withdrawing $120,000 from the market, they only need $50,000. And if the market drops by 20% in year 1, their growth portfolio drops to $800,000. Their withdrawal is only $50,000. So their ending balance is $750,000. Meanwhile, the income producing multifamily assets continue paying. With $50,000 annual withdrawals and 7% long-term returns, that growth portfolio extended well beyond age 90. Same capital, different structure. But which investor do you think sleeps better? And here's the key insight. This has nothing to do with being smarter. It has everything to do with designing your income intentionally. Now let me show you how to put this in motion for yourself and how to make it repeatable. At Ellevest, we use what I call the passive framework. And before I explain it, understand this. If an investment cannot score well across these categories, it's not a true income vehicle. We start with predictability. Predictability comes when you have a true, passive, recurring, diversified income. Then we move to alignment. Does your retirement investment strategy require your time, and is it aligned with your long-term financial goals? Next is safety margin. Conservative underwriting, strong reserves, smart debt, and clear cash flow. Overall, how safe is your portfolio from loss? Next is scalability. Can you grow your portfolio without increasing complexity? Inflation resilience and then income resilience. Can your income rise over time, or does your income decline as you withdraw like most typical 401k plans? Next is volatility exposure. Is income driven by operations or headlines? This single differentiator matters more than you think, and it can tank your portfolio value if you're not careful. And last is exit clarity. Do you understand how and when your capital returns? Is your capital compounding and growing upon exit, or is it slowly dying every time you withdraw? Let me tell you why this matters to me personally. For over 20 years, multifamily real estate has been the core vehicle I've used to build my family's wealth. Not because it's flashy, not because it's trendy, but because housing solves a real problem. People need a place to live in every cycle. And when you buy well, finance conservatively, and operate efficiently, it produces income, and income changes everything. It reduces stress, it creates optionality, and it gives you leverage over your time. That's why my mission is simple: to help people like you create real wealth and passive income through investing in multifamily real estate. You just need to ask yourself, do I want money growing and compounding so I have more income to live off of every year? Or do I want my money diminishing and my income essentially going down every year? We all know that life is getting more expensive, not less. So for me, the choice is simple. Let's finish with this. There are two types of investors. There are those who hope markets cooperate and those who engineer income deliberately. Freedom is not a net worth number. It's a system that pays you whether you work or not. If you're ready to start repositioning part of your portfolio towards engineered passive income, visit ellevestcapital.com and book a call with our team. We'll evaluate your goals, your portfolio structure, and your income targets, and we'll determine whether multifamily investing aligns with your strategy. And in the next video, I'm going to show you the 7 red flags that destroy real estate deals, so you know exactly what to avoid. I'll see you there.